recording of this. Okay, we're going to begin the podcast that's focused a little bit differently than our chat room activity, which centers around index trading and being able to both indexes and large liquid stock names. But we wanted to talk a little bit more about options and in particular the under the radar risk of using options to capitalize on volatility opportunities. There have been volatility's been a big game of late, and one of the newest moderators in our chat room, Phil Zucchi, is going to be with us today, and he has contributed prolifically to Minionville and has written a number of articles which I think you'll find very interesting, and I'm happy to provide links to those as perhaps he is as well. He has a very interesting and kind of comprehensive view of the macro world and how it applies and how he uses it to extract value and locate opportunities in the options chains. So what I'm going to do then is I'm going to turn the presentation screen over to him and give him a chance to dial you in as to some of the features of that approach. All right. That should take care of it. And I think I'm looking at your screen now, Phil, so it looks like it's working.
Okay. Well, good afternoon, everyone, and thanks for joining us. What I would like to go over this afternoon are some of the more hidden aspects of options trading. And so I would say that this is probably a webinar that will be useful to people who already have a basic understandings of how options work, but sometimes may be puzzled as to why options behave the way they do. And hopefully today we can clear up some of that confusion. So just to get up to speed, the key topics are going to be centered around the issue of volatility, and specifically there are two types of volatility that we're going to be talking about. The first is implied volatility, and the second is historical volatility. From there, we'll try to move on to some of the strategies that can be put into place based on by using volatility to your advantage, and trying to understand a little bit how changes in volatility can affect those strategies and also can affect the exposure that you have to the underlying stock or index that you're exposed to. So first of all, the basic pricing of options is done through the Black-Scholes model.
Hey, Phil.
Yep.
Are you going to put up a different picture than your email?
Than my email? Yes. I'm gonna. Yeah. Sorry about that. The Bloomberg screens are all over the planet here. Hold on a sec.
Hi, everyone. Welcome.
All right. Let me see if this works better.
You can't hear me.
Hi, Maddie. How things going?
Good. How you guys doing?
Very
Incredible day.
Oh, wow. That was fantastic.
Nothing like pinning, eh?
I'll say. That Apple trade was off the charts.
Unfreaking believable.
That was just too
I
great.
couldn't believe it.
400 tagged it. You had that $8 lower, I think. Maybe more.
Yeah. Yeah.
Do you guys see the Bloomberg screen as well as the webinar column, or just the Bloomberg screen?
Bloomberg only.
Bloomberg only. Okay, good. All right. So as I was saying, option prices are calculated using something that it's called the Black-Scholes model. And I don't think we need to get into the weeds of the mathematics, probably because I couldn't even do that anymore. But it basically uses 5 components. the price of the stock, the expiration of the option, the strike price of the option, and then the free rate of interest and the dividends that are associated with the stock and the risk-free interest rate in the markets. Call it the Fed fund rate. And then the fifth one is implied volatility. Now, the first four are known. There are four known variables. Anyone can pull those up on his or her machine. And if the fifth one were also known, then there would be really no secret or no magic to options trading, because we would know all the inputs to an option price, and off we go. Unfortunately, when it comes to implied volatility is not a tangible item. I'll give you a quick definition of what implied volatility is. It is a measure of expectations established by market makers based on all the inputs that they have available, from the flow of options, in other words, how many options, how many puts and calls buyers and sellers are trading, to the historical volatility of the underlying stock, and probably most importantly, the psychology and the sentiment around the underlying stock. So when we talk about implied volatility, we truly are talking about someone's estimation of what will happen in the future. And in a way, this intangible is what creates the opportunity, because it allows us as traders to determine whether the expectations that are being set for us in the market are reasonable or are out of whack. And we can come to those conclusions based on however we trade and however we look at things. But we then have a choice to buy that volatility or sell that volatility, depending on whether we think that it's expensive or cheap. Now, the implied volatility that you can find on many data feeds, and you can see a column here on the Bloomberg under IVM, it is reflected in percentage. Okay, so we're looking at the SanDisk. These are the weeklies. Let's just go to the monthlies. So the weeklies, the monthly 62.5 calls for SanDisk are trading at a 40.3% volatility. Now, what does that mean? What does that percentage mean? That percentage reflects the market makers' belief that there is a 68% chance, and I'll get back to why 68% in a second, but a 68% chance that a stock will move within the implied volatility percentage, so 40% in this case, within the following year. So let's make it simple. If a stock trades at $50 and the implied volatility is 20%, it means that market participants, market makers preeminently, believe that there is a 68% probability that the range over the following 12 months will be between $40 and $60. Now, what is that 68% and why the 68%? That's the one standard deviation. So that when you look at your normal bell curve, that's the 68% is where it would fall under. Again, I don't think it would do anybody, it wouldn't be very interesting to delve into that, just as long as you understand what that means. We will talk about calculating implied moves on shorter time frames later. Okay, so for the time being, the implied volatility and the implied underlying move pertains to something over a 1-year period. Now, that's sort of the definition of implied volatility.
Hey, Phil?
Yes.
Can we take a look at the Apple
Sure.
spread just because it's relevant to our calls today, and it'd be interesting to see how it stacks up because there's some interesting opportunities we think from a different perspective, but this may shed some light on it.
Yeah. You guys want to look at the monthlies as opposed to the weeklies? I think the weeklies have some quirks that.
Yeah, let's go monthlies definitely. We don't need that. You're right because you get too short in time and they get funny. It's like quantum math, right?
Something like that.
Yeah, I like the monthly. I think that's better. Gives us better indication of where Apple could go.
Yeah, and I think I was going to use Apple anyway to look back at what happened the last earnings release and how it may play into the next earnings release. Okay, so here we have Apple up, and the monthlies. When you want to determine the implied volatility at any given moment, you need to look at the at-the-money implied volatility. So the stock is at 396. We're going to take the 395s, and that implied volatility is 26.6%. Now, you can also see that there is a slight excuse me. There's a difference between the call implied volatility and the put implied volatility. That's something called the skew, and we'll touch on that later on, but it's not really that relevant to this discussion, at least for today. So the second type of volatility that we need to understand is what is called the historical volatility. Historical volatility is nothing more than the measurements of volatility of the swings of the underlying stock over a period of time in the past. So this is not an intangible or an unknown variable. This is just something that is calculated day after day after day, and it's available on many platforms. Now, the reason we need to know what the historical volatility of a stock is over a certain period of time, as well as something that I call probably not a true term of art, but it's something that I've been using for a long time. It's called adjusted historical volatility, and I will explain this now. Let me change the screen for a second. Okay, so hopefully everybody can see here. This pertains again to Apple. And what you have here in the first column under historical volatility is the actual swings annualized that the stock has had over a 1-month period, a 2-month period, and so on and so forth. And to the side here, you have the implied volatility. In other words, despite whatever the historical volatility is, the implied volatility, again, gives you a sense of what people expect the swings will be in the future. 1 month out, 2 months out, 3 months out, and so on. Now, something that comes into play when we talk about adjusted historical volatility, and hopefully I can make this clear, but it's a concept I've always had a little bit of trouble explaining. Let's say that you're coming on to earnings like we are next month. There's going to be a lot of positioning, either on the bullish side or the bearish side of any given stock. So the likelihood is that the volatility will increase during the next 2-3 weeks until the earnings come out. Now, that is before what I call the big bet event of earnings or unemployment numbers or whatever catalyst you may want to choose. But that tends to skew what is in fact the actual volatility that you can then expect post the release of those catalysts, the earnings, etc. So I find it useful to sort of go back either a month or two and look at what is in fact the historical volatility if we smooth out catalysts that have occurred in the past. And this is what you see below the green line, is basically that. So the 1 month, again, call it adjusted volatility, historical volatility, here is 27, 2 months 29, and 3 months 28. That, to me, reflects what we could expect in terms of volatility of Apple stock in a normal environment when there are no big catalysts looming in the future. And that becomes my reference point on what I want to compare against implied volatility. And now we get into whether, implied volatilities are cheap or expensive. As a rule of thumb, if the implied volatility for a given period of time, let's call it 2 months out, is higher than the adjusted volatility 2 months back, then those options are expensive. Conversely, if the implied volatility is lower, those options are considered to be cheap. And again, it has got nothing to do with the price of the option. Okay? The price could be very high just because we're dealing with a high-priced stock or whatever other reason. But how intrinsically expensive or cheap is the option? And I think getting into options, buying options when they're cheap or selling them when they're expensive is pretty much the only way to make money. If you buy an option that is very expensive or sell one that is very cheap, on average in the long run, it's going to be difficult to make money. So let's take, since...
it's kind of like buy high, low.
Yeah, it's sort of like buying a low PE or a high PE. It's the way you can look at an option is sort of the same way you can look at a stock. If a stock trades at 90 times earnings, it's expensive. If it's only growing, 20 or 30%. Same thing. If an option is trading at 90 implied volatility, but its historical volatility, it's only 30, you're way overpaying for that option. And it's going to be very difficult for the price to move so much and within the period of time before expiration that you will be able to make money. You may be able to do it once, you may be able to do it twice, but if you use options on a regular basis, chances are you're going to lose. So let's look at Apple and its adjusted volatility and its implied volatility. Now,
nice explanation, Phil.
I'm sorry?
I said nice explanation.
I try. I don't always succeed, but I try.
Okay.
So here we see that the 1 month adjusted historical volatility for Apple is 27. All right? So we're going to jump up and look at the July. Now, note something here. The July options this year will not cover the earnings release because earnings are coming out on the 24th of July, and the July series expires on the 22nd. So if you want to look at monthly options that capture the earnings release, you got to go to August. And here you get implied volatilities for August of 29, of almost 30, versus the adjusted, call it 2 months at this point, since we're going to August, of 29. So what this tells us is that the August options for Apple are fairly reasonably priced. They're not cheap, they're not expensive. They are consistent with what the historical behavior of Apple has been over a 2-month period that overlaps an earnings release.
Phil,
To distinguish this, yes?
what's the Bloomberg function? How do you bring this screen up?
TRMS.
Okay. Thomas, Radar, Nancy?
No, Mary.
Mary. Okay.
Yeah.
TRMS. Gotcha. All right. Thank you.
So let's go back to the weeklies for a second and see instead the option volatilities immediately surrounding the earning release dates. And what you will see, at least I'm fairly confident, is that those volatilities are going to be significantly higher. So scroll down. Let's see, this is the 12th. Okay, so the Julys at the money, the 395s, are trading for 26. So these are in fact cheap to historical volatility. But if we go one more down, and this will kick us into the July 26 series, you can see that the volatility has gone from from 25 to 33, and these are about 4% more expensive than historical volatility. The reason, obviously, people want to trade these and are more concerned about the reaction of these options because they capture the earnings release, which happened 4 days prior to expiration. So that sort of gives you a sense of what I mean by cheap options and inexpensive or expensive options. Now, how can we use this to our advantage? Well, there are many ways that you can look at volatility and decide on how to use it. First and foremost, you can obviously buy cheap and sell it if it's expensive. But you also have to take into account whether that volatility may get even more expensive or cheaper at a later date. And that is something that is difficult to do looking forward unless you know how certain stocks have behaved in the past. So let's go back to Apple for a second and pull up. These are the May 3rd calls, at the money calls. Let's see. Bear with me a second while I shrink the time range. Oops. Okay. Hopefully everybody can see this graph fairly clearly. But what we're looking at are the Apple 405 calls back on between April 13th and April 26th of this year. Now, this past April, Apple reported earnings on the 23rd afternoon. and it reopened obviously for trading on the option started trading again on the 24th. So what you can see here, and I think everybody who has been involved with Apple knows that this past earnings release was kind of a tense moment for the company. There were a lot of cross currents, a lot of people saying, well, they're coming back, they're going to be the good old Apple. Others were saying they're going to hell in a handbasket. So there were a lot of different opinions and a lot of pulls and tugs on the stock. Well, what that does is that it pumps up the volatility because you got a lot of people putting a lot of money on both sides of the fence. And when market makers are finding buyers, lots of buyers, not non-price sensitive buyers of both puts and calls, implied volatility has to rise. And sure enough, the white line is what shows the implied volatility. And we went into earnings the evening before, the afternoon before the release, where the implied volatility of the at-the-money options was almost 60%. Now, think of this in terms of where the the July's post-earnings are trading right now, the ones that we looked at earlier. They're only trading at 33. So relative to where those options were in April, these weeklies are fairly inexpensive for now. It may well change as we get closer and closer, and I expect it to change as we get closer and closer to the earnings release. But in April, it was wildly expensive. So we were comparing 60% implied volatility versus our normalized of about 25 to 30, call it, somewhere in the 27, 28 range. And this is probably, the quintessential example of the disaster of buying expensive options. Why? Well, the stock before the report went out at $405. As it turns out, the stock the following day, post-report, closed at $406. So there was a $1 movement because of the earnings. Now, look at what happened once the mystery around earnings was no longer there. When the expectations of the crowds was removed because we now finally had the facts on what was going on with Apple. It mattered not to anyone that the stock did not move, moved a dollar, basically did not move. The implied volatility, again, the white line, absolutely collapsed. And it collapsed down to 27.8. This was the following day. Okay? Oddly enough, right in our range of where we expect normalized volatilities to be. And then as the next couple of days passed, these went off, they went even lower, and there are reasons for that. But that's really not the important part. The little tail from 27 to 22 is really not an issue. This would have been the issue if you were long the 405 calls straight up. And sure enough, the price of the option is in brown. It's this brown highlighted. Does it highlight when I scroll over it for you guys as well? CP?
Yes. The orange line.
Yes, it does.
The orange line brighter. Yep.
All right. So the orange line, you can see that the options went off on the 23rd evening at $17.80. And the next day, despite absolutely no change in the price of the stock.
The price, the underlying price is the green, right?
The underlying price is the green.
Gotcha. Okay.
And your options were now worth $7.60.
You have massive event risk on the 23rd. All that event risk is sucked right out. Volatility drops on the 24th. Look at that.
And you're toast.
Yeah.
If you're long the puts or the calls, you are in a world of pain.
Yeah. Wow.
Is that why it's better to do like a put spread or a call spread?
Right, and we're going to get into that, into how to mitigate these type of problems, especially around earnings, in a second.
Okay.
But what I wanted to show everybody, at least initially, is that the price of an option is almost entirely dependent on the implied volatility, as long as those volatilities are above the historical volatility, what is also known as theoretical value or fair value. You are in essence buying somebody's hopes and beliefs. You're not buying anything tangible when you pay for implied volatility. So, to what Maddie was just brought up, how can we mitigate the risks of overpaying for volatility, or how can we take advantage of different strike prices and different volatility levels as you move out the strike prices, as you move away from the money, to set up positions that will be defined in how they behave. So they will limit our upside, but they will also limit our downside, and not only that, increase the likelihood that we can make some money out of it, because in essence what we're doing is that we are selling sometimes once, sometimes twice, depending on the structure of the position, the hope and dreams that everybody is overpaying for. So the first setup that we can have, and I'll take a couple of examples here. We can go to, hold on.
Hey, Phil?
Yep.
Phil?
Yes.
Okay, I don't know if this would work, but let's say that I have a call on Apple earnings, and I think that the long for the upcoming quarter is going to be, that my earnings call for Apple for the upcoming quarter is going to be a long. And obviously these numbers are just kind of random, because I don't know where Apple's going to be trading closer to earnings. But say, for example, I think that Apple's trading at around 408, 410, and say the measured move is $25. So for me, I would say that the call is Apple long. I think that it may come down and retest the 395 level, and then it pops up to 425. How would my
425, you said?
Yeah, say I think that the low is going to be, it may come down, it's going to be a drop and pop, right? So Apple may come down and test the 395 level, but ultimately I think that it's going to hit 425 or 420.
Okay. There are a couple of things that we can do to deal with that scenario. I assume that when you say that the stock is going to drop to 395 and then pop, are you talking about after hours, the afternoon of the release? Okay.
Yeah.
That's something that we can deal with in a different, a little bit later when we talk about deltas.
Okay.
And how we can maneuver that in after hours when options do not trade, but the stocks do. So the first one, let's just say that we are going to overlook your drop in the after hours, and we're now, let's say that we're at 396. Let's just take the price that it is today, and you think that the following day the stock will move up to $435. Okay. Now, as you can see here, the 410 call options post-earnings, post-July, right now are going for $8.55 to $9.10. And the 435, which is our target price, is the options at 435s are 280 to 305. Let me change the screen for a second and see what happens here.
Phil, we have an interesting question.
Yep.
Tina was wondering, what's the difference between open interest and volume on an options chain? Example, options in 1100 versus volume of 211.
Yep. Okay. This deviates a little bit from what we're talking about, but I can answer that fairly quickly. The volume is the number of options that are traded in any given day. And options, unlike stocks, are, technically speaking, are traded by the market makers. Okay? When you buy a stock or sell a stock, yeah, there may be a specialist involved, or at least there used to be in the old days. Now it's just electronic. Somebody wants it, you want to sell it, boom, you're done. But in the options market, the risk of an option position is still absorbed, is still taken by the market makers. So let's say that there is a new option series. Let's call it the November options for a stock, for Intel, have not traded. Today is the first day that they rolled them out, and it's the first day anybody has an opportunity to trade them. So there is no open interest and there is no volume, right? They're brand new. And let's say that through the first day of trading, there are 20,000 contracts bought by somebody, by the crowd, so to speak, and 18,000 contracts sold. That means that the difference, the 2,000 contract difference between those that were bought and those that were sold, are positions that sit on the book of the market maker. That's his exposure because more people wanted those options than there were people to sell those options. And he's now, by virtue of his job, in the position of having to hold the short side of those calls. He is short 2,000 of those calls, which are the excess that somebody, the crowd, is long. That is the open interest. Okay? And what market makers do is that based on their open interest, and this is something that the machines do so that they get to hedge it on a real-time basis, based on their existing open interest, they go out in the stock market and hedge themselves out so that they don't run the risk of blowing themselves up. They could lose, but if they hedge correctly, and the machines are obviously take care of that, the risk of loss is relatively small.
So Phil, when you say hedge yourself out, they go out a couple of weeks, or do they go out?
Well, it depends where the open interest is, right? So let's say that the November calls that just started rolling out are 3 months out. What they will do is that the market maker will look at the delta of those options, and I will talk about delta in a second. But in essence, every option has a delta, and you can see the column here. Okay, this says delta right next to implied volatility. What the delta is the expected move in the price of the option for every $1 move in the underlying stock price. So what market makers as a general rule want to be is that they want to be in a delta neutral position. So let's go back to our example on Intel. They are, at the end of the day, they find themselves short 2,000 contracts. That's the equivalent of 200,000 shares. Okay? So if they didn't do anything else, if they just went home with those 2,000 calls short, it's as if they were short 200,000 shares times the delta. Okay? So if the delta is, in this case, I don't know why they put the decimal period
Yikes.
between. It should be before the 4, okay? Because the delta is always a number between 0 and 1. So if you take those 200,000 shares and multiply it and assume that the delta is 0.42, I'm just making numbers up here, or 40, it's as if they went home net short 80,000 shares. Not a comfortable position to be in, right? Because you wake up the next morning and bad things could happen. So what do? Right as this open interest, builds up to 2,000 contract, they short a delta neutral amount of stock against the open interest. So if they are net short 2,000 contract, 2,000 call options, they look at the delta, they determine that that's the equivalent of 80,000 shares. They go into the stock market and short 80,000 shares. So that they go home and they know that based on the delta and their open interest, they are essentially flat. Now, of course, the delta will change as the price changes and as the volatility changes and as a lot of other things change. And that's why I say that the machines take care of constantly rehedging their book so that they remain delta neutral. And the question and the trick for them and the risk for them is to be able to keep up with that type of rehedging when you get tail type events, weird events like the flash crash or whatever else, where the availability of the hedge, whether it be short stock or long stock or whatever you want it to be, or the volatility that explodes so high that it brings deltas out of whack, puts you in a position where you cannot effectively hedge. And that's what these guys basically get paid for, to take that risk. So that, again, that was sort of a deviation from what we're talking about, but that's what the open interest is and why the open interest is relevant to what's going on. And if we have time later, we can also jump into the issue of pinning, which is something that Maddie brought up in the chat room today. That's quite a large discussion, so I'm not sure how much time we have to get there, but it has to do with the deltas and their rehedging around large open interest strike prices. Okay, so let's go back to our Apple example, all right? And we will take, let's see, today the valuation date is, well, let's just take today. And we want to know what happens to our options the day after they report, or a couple of days after. So let's call it the 26th of this year. All right? So,
Hey, Phil?
yep.
You know, the way we can maybe include the pinning is in with this Apple open interest. Like, for example, we can say, today's open interest was.
Yeah, I think that the pinning discussion around weeklies is really not that effective, because the weekly open interest, as large as it may be, open interest is relevant to pinning as long as it's so large relative to the daily number of shares traded that it's almost bigger than the amount of the average trading volume on any given day. When you have small open interest, let's say 3,000 contracts or 5,000 contracts on the put side, and 5,000 on the call side, so you got 10,000 contract total on a certain line. That's the equivalent of 100,000 of a million shares. Well, a million shares, as far as re-hedging is concerned, is not that big a deal. So the open interest would not have the same kind of tug toward that strike price as it would if the open interest on that same line were 100,000 shares. And now you're talking about 10 million shares on each side of the put and the call side. And now you're talking a pretty sizable open interest. Now that open interest would start serving as a magnet as you get closer and closer to expiration. But those type of open interests you tend to see only in monthly expirations. Sorry about the phone, guys, but I don't even know how to shut it off. So,
Sorry.
You're not going to find them except in monthly expirations or quarterly expirations, like what we had today, and that pertain more to the S&P. So yesterday in the chat room, I mentioned that there was a decent size open interest if you combine the open interest in the S&P PIT contract, which is the big contract, the E-mini futures, the SPYs, and then the SPX cash options, which are traded. So if you looked at all those related contracts and you put those open interests together, you could see that the 1600 to 1605 was going to be somewhat of a magnet. Nothing great, but enough that the price would tend to revert toward those strike prices as we got closer and closer to expiration. And sure enough, that's basically what happened. Now, what you mentioned today in the chat room, I was talking to CP earlier about how things might behave in the last hour around option expiration. That's an interesting item that I really never thought about, and I'm not sure how it works into the options. I got to try to figure it out and see what it means, because I wasn't really clear.
Yeah.
For me,
What was that?
well, you were saying that in the last hour, if the stock is if you have if the stock is moving up going into 3 p.m., it will tend to then pin at a lower strike level and vice versa. And I'm not sure how I can, that may be a technical thing from a chart issue.
I've just seen that time after
Right.
time on pennies.
Right.
More for the weeklies. I mean, less for the weeklies, but more for the quarterlies.
Yeah, and it may well be the case. I'm just not sure in my head I understand the mechanics of that from an option expiration open interest standpoint. Where was I? Okay, so we've got our Apple chart up here, and we will use the 395, which is the at the money. You can see it's in white. And this is where the options are trading at right now. And we need to figure out, you need to understand and see how we get to the price of $15.50 for the 395 calls. Okay? The 1550 at 395 have a 33.6% implied volatility. Now, let's say that we're getting closer and closer to the earnings, and the volatility explodes, just like it did the last time. And we go to, it's now the 23rd afternoon, and we have had an increase in volatility from 33.5% to 60. So that's 16.5% increase in volatility. Okay? This tells us that those same options, those 395s, which are going to for 1550. See, I got to change this. I'm sorry. There is time decay here, so I got to move us up to the day before, let's say. How can I show this? Blah, blah, blah.
Are you trying to adjust for the 1 day of decay?
Yeah, I never used this particular function for this demonstration, so to speak, so I'm trying to figure out where to put in the right numbers. Because right now we're getting numbers that don't make much sense. I may have to use, let me use the weeklies for next week.
Okay.
And bring us to today. And let's just assume, for the sake of argument, that earnings are next week.
All right.
Okay, so let me readjust this back. So today the 395s are at $6. Okay. Sorry guys, but this is, as I called the Bloomberg a Ferrari of terminals until you realize that they forgot the mirrors button every once in a while. Things move around on you and you don't know why.
Yeah.
Okay, so here it is. All right. So today the 395s are $6 and are trading at 24% volatility. Okay. Now we get to the evening before the expiration, the 4th, and the implied volatilities have moved up to 60. So we're going to add 30, call it 36. Okay, and the price has not changed. The price of that, with 1 day to go, the price will have fallen. See, this does not work well. Will have fallen to 150 because there's time decay. But if were it not for the increasing volatility, so we'll go back to 0. No, this is not calculated. I don't know. Sorry, guys. This is not calculating the way I thought it would be working. It worked last time. I remember that. figure out how to adjust. But, well, it's basically the same thing that I was showing you guys earlier, right?
Right.
On the screen.
Yeah, you could see it on the graph captured it. I thought
On the graph, right?
Yeah. Yeah.
So we'll go back to that one. Oh, great.
Oh, Greg is suggesting that there's day to expiry and days later boxes that you can play with in that might
Yeah, I'm sure that if
might do it.
but I don't want to take up too much time
No problem.
messing around with this, trying to figure it out while everybody's on hold, basically, or watching. Okay, so I know how to do it. Okay, here we go. Let me go back to.
That's interesting. Dennis has a good question. With options, volume, and open interest, is there a way to tell if open contracts were bought or sold? I guess he's meaning whether it was just a market maker that was on one side of it.
Yeah, it's very, very complicated to figure out.
I don't know of a simple indicator that, like tick or something that would show you who hit the bid or the offer. So
I don't know of it either, to be honest.
Yeah.
Oh, don't be so mean to me, Mr. Screen. Come on. These are the weeklies. That's the other problem. See, the weeklies don't go back that far. So
right. Some of these calculations, can you even get enough data if they only go back?
the something that happened with Apple is that the general rule for weeklies is that they roll them out every Thursday morning for the following week. But for Apple, for some reason, they decided to roll them all out. But that only happened relatively recently, so I cannot get data on the weeklies going further back. So we're going to have to use our imagination here. Let's say that this is the price and the implied volatility that I was showing you earlier.
Hey, Phil?
Yep.
What about doing Goldman?
Try. I don't know when Goldman reported, so I'm not sure that I can, off the top of my head, bring up something that makes sense.
Okay, you know what? Let's just stick with Apple.
Yeah, let's just stick with Apple. Okay, so look at this for a second. Yeah, maybe you can see a little bit here. Let's assume that the volatility is further back than the 18th of April, which is as far as the data goes back, were 30. Okay, you can safely assume that the option price was a lot lower.
Mm-hmm.
As you got closer and closer to the reporting day, the volatility expanded. Again, this white line would be a lot steeper, and it would start dragging up the price of the auction, even though the price of Apple stock is probably not changing that much. Okay, so those matrices that I was showing you earlier basically would have shown you this type of dynamic, where the implied volatility starts pulling up the price of the option regardless of the move in the stock as you get closer and closer to the bet event. So we have used our imagination. We're now the day before the release of earnings, and you get the same dynamic. You risk, if you're just buying these things straight up and paying 60% volatilities, you run the risk of taking a bath if the stock does not move. So that brings us a long way around to going back to the issue of spreads. What you can do is, if you decide that your range for Apple is going to be 410 to 435, again, let me go grab these things. Okay, let's assume we have a straight spread. So you are either short contracts, or you just want a long position and you want to hedge it, or you just have a straight, you just want a straight long position. You buy 10 of the 410s and you sell 10 of the 435s. That captures the range that you're interested in, because your analysis says this is where the stock is going to end. Now, we can see how this position will behave as we get closer and closer to the earnings, and then as we get closer and closer to expiration. And this is going to be a chart. So we'll use this. Here I may be able to show you what I meant. Hold on. Okay, so this is basically just a graphic projection of what would happen to your position, and here you have the actual dollar amounts, if you bought that spread today. Okay, the price is about $3.95. Buying that spread today, the 410, 435, would cost approximately 9 minus 3, call it $6. Okay, that's what it would cost you. Sure enough, at expiration, you can see the green line and the white line. At expiration, you would need the price to be at 416 to make money. That's your break even, where the green line crosses the white line. Okay?
Yep.
Above that, you make money all the way to 435, and then you flatten out, because it's basically it's as if you had no position. This assumes that the volatilities remain effectively the same as they are right now. But look what happens if we pump up the volatilities 36%. So we're getting closer to the event. We're now July 16th, and the event is on the 24th, and these expire on the 26th. And these things are getting pumped up, pumped up, pumped up. You can actually be up $4,000 in your position, you see can you see the little scroll thing on the right side of the screen?
Yeah.
Over here?
Yeah.
Okay. So with the stock at 410, you can see that your spread position is in the money. It's profitable to the tune of $3,703.
Yep.
Right? That's simply a function of the fact that the implied volatilities of your 410, even though the 410 are still out of the money, right? They have no intrinsic value because the stock is still at 409 or 410.
Right.
Those volatilities have expanded so much that they will give you a profit despite the fact that the same volatilities have expanded on the 435s, but since the strike price is so much further away, the change in the delta is not going to be nearly as much. And so you will show a profit on that position purely by virtue of the fact that you have enjoyed the ride from 24 to 60.
Right.
Okay? If we knock this out, if we bring the volatility, if the volatilities do not expand going out to the 16, you can see that your profit at 410, and remember the price right now, the stock right now is 395, okay?
Right.
So we're already assuming that the stock has moved up to 410. But your profit at this point would be a measly $1,300.
Wow.
Because the time decay has eaten into the price of your 410. It has eaten away into the price of the 435s. But you have not had the benefit of the boost in implied volatilities. Okay? So, spreading options ahead of a big bet event is very useful if you are convinced that the implied volatilities are going to go up, because you can take advantage of, before the event, of the expanding volatilities, and after the event of your assumption that the stock price is going to move toward your target of 435, at which point the following day, even though the day following their earnings release, even though the volatilities will collapse, as you can see on the green line, because we have not adjusted the green line, the volatility remains constant. The stock price will pick up the slack and start making you money on an intrinsic basis, because that's real value that you have between the price of the stock and the strike price of the option that you are long.
Right. In this example, you almost, if you had that spread on, you could make enough on the long part to just exit it, and then the short leg of it would win just as the event passed.
That's right. Unless you guessed wrong.
Exactly.
Yeah. I mean, but it would have to go quite a bit to be wrong given the distances. So.
And that's why I suspect they carted off a whole lot of people in the Netflix case.
Oh,
right?
yeah.
Where, or for that matter, I got slammed in a biotech name because you not only have sold this stuff naked, but remember when you're selling it, right? We're selling it now when the implied volatility of the 435s is relatively low.
Right.
That's why we're doing it now. That's why we're setting up the spread now to take advantage of the expansion in the implied volatilities later.
That's true.
So if I get rid of my long only, and I'm left with my short 435s, I have incredible exposure from a price standpoint, and I have not been compensated enough.
Yeah, you'd have to put the spreads back on the other side, I guess.
You got to either roll it up,
meaning
you go from a 410, 435 to a 435, 465, whatever. But staying naked
That's not gonna.
calls in front of a catalyst is, it's pulling a grenade in your mouth, putting a grenade in your mouth and pulling the pin. At that point, you just pray it doesn't go off. Now the put
Same
is a
thing
little
with
different.
shorting.
Same thing as shorting.
Right.
Only there's a big difference. That shorting you can cover after hours.
True.
True.
Your short calls,
Phil,
you better be able to hedge after hours.
In your example, you used a volatility.
Wait. On that hedge, you can always buy shares.
Yeah.
If you're short after hours in your options, you can always buy shares, and I've done that before.
Yep.
Right. No, that's what I said. As long as you have access to after-hours stock trading, then you can try to hedge yourself after hours. But, Apple, for example, we'll continue with this. You know that they halted at 428 every time.
Oh.
Right?
Yeah, I know. My belly gets very big butterflies in it.
Yeah, and
I get so scared and nervous. It's crazy.
And when they reopen it, if it's at 500, because Tim Cook decides to take this thing private, then what do?
Yikes.
You're in a heap of pain. So, now let me go back to something that I use a lot, and that I think it's probably one of the lowest risk, difficult reward, but sometimes such low risk that you can sort of spread this position around. And my experience is that, on average, you tend to make money. And that's the use of butterflies. Now, what butterflies are nothing more than a long position. We'll stick with the Apple idea here.
Nice transition into the butterfly with my butterfly comment.
That's right. Good pickup. All right, so we've got the 410, 435. So the next leg up is going to be a 460. Let me go grab the 460s. And apologies to those who are already fairly well versed on options. This webinar is meant, for people who sort of just buy and sell stuff, and now we want to move up, a little to some stuff that is a little more complex. But okay, so a butterfly simply consists of going long a given strike, 410 in our case, and we'll use 10 contracts, shorting twice as many of another strike, and you can choose whatever you want. We'll stay with the 435s. And then protecting the excess short position, the excess 10 contract, by buying the 460, which mirror in distance, mirror the distance from 410 to 435. Okay? Now, since we're selling the body, what is called the body of the butterfly, right? These are the prices. So we've got 882 minus 292 twice, and then plus 85 cents. This position costs us $3.80, call it 85 cents per contract, per butterfly position. And it gives us, that is our, by the way, that is the maximum we can lose, okay? Butterflies are risk-defined positions. If you keep the butterfly all the way through, in other words, you do not break it up at some point, you keep it as a single position, whatever you pay for the butterfly is your risk. You gotta, there's just no way around it because it's basically a collar type structure. So why is that? Because If the stock goes from 410 to 435, well, great, right? You make money, and if it expires at 435, your 410s are worth 25 bucks. Your 435s are worthless because there's no intrinsic value, and your 460s are also worthless because there is nothing there. So you paid $335 and you walk away with $25. Not a bad rate of return. Okay? But let's say that our nightmare scenario is that Tim Cook does LBO Apple the day after earnings, and the LBO price is 500. Well, big deal. If you were naked short, you're dead, right? Even if you only had, and I'm going to uncheck this, if you were long 10 and short 20, which is called a ratio spread, you have made money from 410 to 435. You start losing money from once the stock goes you start losing your profits when the stock goes from 435 toward 460, the distance between the two strikes, and then above 460, you are effectively naked short 1,000 shares of Apple. Bad news. But if you've got your little protection for which you're paying very little over here, what happens? The stock goes to 500 and it's now expiration. Your 410s are worth 90 bucks. Your 435s, you got to pay out 130 bucks, right? $65 times 2. But you're also making another 40 bucks on the 460s. So even though everything went wrong for you, you completely miscalculated what was going to happen in that going into that catalyst. You made 90, you lost 130, and you made 40. So if you had not, which is a net of 0, had you not had to pay the premium of $3.85, it would have been a cost-free position. And of course, there are no unicorns, so you're not going to find a cost-free position. But at least all you have lost for being completely wrong is $3.85. And these are very useful positions. And let me see if I can find stock that has very high implied volatilities. What could it be? Netflix, maybe? You guys know Netflix reports? The 24th also. All right, so let me see.
Hey, Phil?
Yeah.
If we have time, can we go into selling puts?
Selling puts? Sure. You guys want me to, we can wrap up the butterfly discussion right here. I think I described.
I think that was excellent. I think that was perfect.
Okay. Well, we can talk about selling puts.
So
selling put.
Just so you know, the way I usually use selling puts is I usually hedge it against a short position. Like, for example, today when I thought Apple was going to turn, instead of giving up my short position on it because I'm short from much higher prices, I actually covered some of my short and then I sold a put for a hedge. So
okay.
That
is being short a position and selling puts against that position is the exact mirror image as being long a stock and selling a call. Okay?
Right.
We call them cover call, and on the other side, I don't know if you call them cover puts. I'm not sure what the term of art is. But basically, you have very defined risk because you're in essence, when you sell a put against your short position, you're doing nothing more than capping your profits on the downside.
Right.
because somebody at some point is going to put the stock to you, and you got to cover, basically, right? So those are very effective trading tools, and I do agree with you, Maddie. The weekly options from a cover call, or let's call it cover put position, are very handy. Why? Because, and this goes back again to volatility. The retail investors tend to be buyers of options, right? And they like that short-term aspect of the bet. So you can almost see options rolling out on Thursday mornings and the weeklies and getting bid up in price by everybody who scrambles to buy the puts or the calls or whatever it is. And that flow into the stock, into the option, jacks up the implied volatility. So if you're sitting on either a long or short stock position and you see that implied volatility come in, selling it, considering how fast that volatility will then decay because there's only 1 week of time left in it, it's printing money. If you want to use that as a dividend strategy, it truly is akin to printing money. It is very hard to not make money or pocket some profits, I would say, selling cover calls or cover puts against an existing position. Now, it says nothing to whether the stock is going to blow up on you if you're short or blow up on you if you're long. Okay, it could go down $30, in which case your cover calls are going to do you fairly little relative to what you're going to lose on the stock. But as far as the option position in a vacuum, it's probably going to do fine. Again, because those things are really expensive when they first roll out. So let me take you let's move on to touch on Delta, and then maybe we can wrap it up there and open up for questions. Understanding Delta, I think, there are several what are called Greeks involved in options trading. And I think Delta is probably the most important one to understand. And I think I gave you a quick definition earlier. But now I want to explain to you guys how you can use the Delta to hedge yourself if you are long or short any position. So let's go back to Apple. We know that the Delta for the 395 that expire on the 20th of July, again, we can just pick any series at this point, is 53. Now, there is a magic to that number being close to 50, and I will explain to you in a second why. The 53, again, means that if everything else remains equal, the price of your option will move by 53 cents for every change for every $1 change in the price of the stock. Okay? That applies to today at current implied volatilities. As time goes by, of course, and you're getting closer and closer to expiration, that delta is going to either diminish if the price is still at $3.95 or increase if the price goes up and the option is in the money. Okay? So let's say that you've done your calculations. You have decided that tomorrow Apple, after the earnings are reported, reopens, and the stock price will not have changed, but the implied volatility would have gotten cut in half. Okay? your delta, if it's 53 to 0.53 today, is likely to be something around less. I mean, I don't know what it is. There are calculators that do that. But it's going to be less. So if you're now after hours and you're long 10 calls, 10 395 calls with a 53 delta, and you don't think the stock is really going to move, or you think the stock is going down on you because the earnings were bad. If you want to take yourself delta neutral, just like the market makers, you can estimate what the delta would be the next day with the stock, let's call it at 390 and same volatility. Figure out that delta and short that number of shares. So if it's 10 contracts, the notional amount is 1,000 shares. Your delta, the delta that you have estimated would be, let's say, 0.4. You can short 400 shares and be relatively protected against the down move in the stock relative to your long option position. And the flip side is for the puts, right? If you are if you're long the stock, well, I'm sorry, if you're long the puts, you would buy stock to hedge your put position. Let me go back to what that number also can mean. And this is very much a kind of a, I don't want to call it a simpleton way of estimating moves, but it is used fairly commonly by a lot of people. The delta is often considered the probability that at expiration that particular option will be in the money, even if only by 1 penny. Okay? So it doesn't tell you how much money you will make if you buy the option, because let's say that you paid $10.50 for it. Obviously, for you to make money, the stock would have to be $405.80 or $405.60, right, to cover your premium. What this simply tells you is that, in general terms, there is a 53% chance that the stock will be at least $395.01. Why is that useful and why is that important? Because if you're selling options and you think in terms of probabilities, what is the probability that I will make money if I sell a specific option? That's what the delta can tell you. There is a gentleman on the stream on Twitter, Pulitzer, and if you, what's his first name, Eddie? I can never remember. Are you there?
Yeah, it's Justin.
Yeah, Justin. Sorry. He speaks in terms of probabilities. You know, I'm selling out of the money puts, or I'm selling out of money calls, and I'm, you know, my odds are. Well, chances are that he's looking at the delta, and what he's telling himself is that if he's bullish on Apple and he doesn't think Apple is going to go down below 370, he's going to look at the delta of this of the 370 put and says, I've only got a 15% chance based on how the option is priced right now that Apple stock is going to be below 370. If you start selling those low probabilities and having somebody buying them for you, on average, in the long run, you know who wins. It's the house, right? It's the seller of the 85% probability that something is going to go out worthless. Now, it's a tricky approach, and on the upside, as it says, selling naked calls is viciously dangerous because there is it can go to infinity in theory. But on the put side of things, I gave this example last time. You know, there's a company that I've owned for a dozen years, Akamai, and you know, we can debate until the cows come home whether I'm right or wrong. It really doesn't matter. It is a company that, you know, if the stock price is around $30, I will buy it all day long. So for me, selling Akamai 30 puts over and over and over and over, it's fine because I'm perfectly content to buy the stock at 30. And when I sell these things and I look at the deltas and I said, okay, not only am I happy to buy it at 30, but the delta of the particular put options that I'm looking at is 20. I'm only risking 20% that somebody will actually force me to buy the stock at 30. So it's sort of a win-win situation if you have a particular name, a particular company that you're absolutely confident in, that you know inside and out, and that you just don't mind buying at a given price. And using the delta as the probability indicator of whether those options will close in the money or not is a good rule of thumb for what will happen. What else? What do you guys want to do? Open it up for questions? Maybe I've spoken for a long time.
We have a question, Phil.
Okay, why don't we open up for questions and see if I can answer some of these questions.
We have a question.
Okay.
What's the margin required for selling the put?
Very good question. And the answer is that I do not know. Most brokerage accounts work off of the Reg T margin requirements. So it would be, I think, and you need to check with your broker, but I think it's as if you took a short position, delta adjusted in size. So if you sell 10 puts of a stock at 50, and it has a 50 delta, it's as if you were effectively short 2,500. I'm sorry, long 2,500 of those shares, right? And I think that the margin requirement is the same as if you bought those 2,500 shares. Of course, if the price goes against you, then the delta goes up, and the margin that would be required the next day would also go up. So you need to have, in essence, you know, the maximum margin requirement that would be demanded if you took a full 1,000 shares position, talking about 10 contracts, at that price. I think that's how most brokerages, retail brokerages, calculate the margin. Again, I can only stress enough that you need to check with your brokers. Some of you guys may be on portfolio margining structures where you can offset the margin requirements of a long position and a short position, in which case then you sort of take the net, and portfolio margining has its own set of rules, and it's really complicated stuff. It's useful to have a calculator on your screen from your broker that says, this is your margin right now, this is how the margin will be impacted by the position you want to take, and then you can decide whether to do it or not. At least that's how my system works. But margins, you got to check broker by broker.
There's a couple of questions that are coming in.
Thank you.
One of them had to do with the Apple example, and it was just someone trying to get some clarification about the percentage chance in the money. So they were saying, so the 355s have a 92% chance of being in the money. Is that right?
Are you talking about the puts, the calls? Correct.
Right.
Now, it's not 92% chance of making money.
No.
Okay?
Just being
It's
the money.
of just 92% chance that that option will be worth at least a penny at expiration.
Right. Right.
Which means that if it is worth a penny, you've just lost $43.94.
Yep.
I mean, sorry, $42.94, because that's what it costs right now.
Gotcha. Gotcha. Now, there's a little confusion about the delta on calls and puts.
Yeah.
And just wondering for a little clarification on that.
Yeah. That is something called the skew.
Yeah.
And to be honest with you, it's been a long time since I actually sat down and tried to remember why is the case.
Is that I thought that had to do with the fact that you can only go to zero, but you can go
to infinity.
Infinity, and that therefore the whole probability cloud is bounded essentially
Right.
on the bottom. That was my understanding. The quick
Right.
understanding.
But what happens is that typically speaking, in a normal environment, certainly in an environment where there are no imminent catalysts, the implied volatility between calls and puts should be very close, with imperceptible differences, let's say. Now, what happens sometimes, and this is for institutional trading more than well, certainly I shouldn't speak
Inversely
for anybody
close,
else.
correct?
But what's that?
Inversely close.
I didn't hear you, Maddie. I couldn't hear what Madison said.
I think she said conversely or inversely close.
No, inversely. Inversely.
Right, inversely.
Inversely what? I'm having a little communication issue here. So let me go ahead.
I posted a link for skew, the people that want to look it up a little more closely from Wikipedia. Volatility smile is another term for it.
Yeah, and that's really something for institutional traders. I mean, guys who arbitrage.
Market makers and arbitreurs.
Yeah, arbitrage, you know, the difference between a normal skew and a steep skew or a flat skew. I mean, it's the kind of stuff that you can do to try to make money if you have, you know, 9 figures to throw around. That's not my world, so I don't want to speak on how that works.
Okay, then let's see here. How does the dividend affect you when you are short calls?
The price of the dividend, as I had mentioned at the very beginning of the webinar, the price of the dividend and the risk-free rate of interest that is applicable to the money, to cash, is built into the price of the option. So if you're long a call or if you're long a put, if you're long a call, you will have paid a price that is been adjusted in the Black-Scholes formula to account for the fact that you're not going to be collecting the dividend. And if you're long a put, which is a way of being short stocks, then the price of the put always reflects the idea, or not the idea, always reflects the fact, sorry, the screen's just went black, that you will not have to pay that dividend. Now, that's for regular dividends. When there are special dividends, like there were a slew of special dividends announced last year toward the end of the year,
Right.
The CBOE and the various exchanges have rules, and you can find those in there is a pamphlet about options, risks, and blah, blah, blah. And it's on the CBOE website. It explains how options may be adjusted for special dividends. And sometimes since you did not receive a large special dividend, let's say a $5 dividend on a $100 stock, what happens is that once the dividend is paid, and let's say you own the 100 strike calls, the price of the stock would go down $5 the day the dividend is paid. So they adjust your strike price down by that amount. And that's why sometimes you have some funky looking strike prices, because if the special dividend was $3.75, then they would adjust a 100 strike call down to 96.25. So
Yep.
options are priced so that people don't get screwed by the dividend.
Right.
Yes, very much true. So that's why you guys will see on Twitter, unless I'm short at much higher prices in a stock, well, like usually SPY, I don't usually hold any shorts into the dividend. I unless, like, for example, if I'm like $5 or $3 or $2 in the money on my short position, I usually just go flat in SPY, because if you are short the stock, you have to pay that dividend. So that's one of the reasons why you'll see me post, don't forget, it's going X dividend, SPY goes X dividend, and here's the dividend price, the best that, I've seen calculated. So that's one thing you, as a person that is short stock, should keep mindful. And usually I will go in and I'll look to, buy a put on SPY instead.
Well, no, Maddie, let me clarify that. If you're buying a put instead of being short the stock, the price that you're paying for that put includes the dividend. So you are paying for the dividend if you buy a put.
Right. And that put will, the price of that put trades at will adjust the next day after the dividend's gone.
Correct.
Right? I mean, it'll have to be, it would no longer be factored in, so.
Well, let's take that example. Let's say you're short let's say the SPY trades at 100, okay? And you own a 105 put that expires tomorrow, and the SPY goes ex-dividend by $1 also tomorrow. Okay? That option, if you buy it the day before, so there is no time decay, there is no time left because it's going to expire tomorrow, and let's assume the volatility is minimal because it's, I mean, the implied volatility is relatively minimal. It's all gamma. In other words, you're already at 1, okay, because it's as if you own the stock.
Right.
The price of the put, of the 105 put, is likely to be $6 because they want you to pay for the fact that the next morning the SPYs will open at 99. So you're not going to be able to take advantage of the drop of $1 because of the dividend payment. You will have paid that dividend to the owner, to the seller of that put, as part of the price that you pay. In other words, the dividend is always calculated inside, is one of the elements of the Black-Scholes formula.
Right, right.
Whether you're long or short, whether you're buying puts or calls. So if you don't want to have to pay the dividend at all, you just got to be out of the position. Because if you use puts instead of the short stock, in one way or another, you will have paid for that dividend.
Yeah, but I was talking, Phil, I was talking the next, after the dividend's paid, then I will usually go and put in I'll go for a put thing.
After the dividend's paid, yes, I agree.
Yeah.
Yeah. I'm talking about staying short a position.
No.
Okay. Yeah. After the dividend's paid, yeah, then you start from scratch. Any other questions?
There was a question about whether delta was affected by the trading direction, kind of the trend of the market or not, whether you saw kind of a bias to the delta, I guess.
No.
I didn't think so. I thought it was pretty mathematical.
Well, that's simply a function of how far in the money, out of the money, and how much time and implied volatility there is in any given option. But it doesn't matter. That's why if you look at an option chain, the deltas at the money are always going to be roughly around 0.5.
Yep.
Why? Because it tells you you got a 50% chance of being right or wrong, basically. And it's the same chance whether you're on the put side of the game or on the call side of the game.
Yep. I guess we got a final question here. Just a kind of a quick answer of what exactly is gamma?
Gamma is the rate of change of the delta. Okay? So it's how much the delta will change by every $1
Right.
change in the price of the stock. So you're talking about a second derivatives.
Yeah.
And understanding gamma is really not that critical unless you're trading options, near money options, right at expiration. Because what happens right at expiration, since there's no time left, is that if your option is near the strike price and the stock moves violently into the money,
Right.
the gamma is effectively 1. So your delta will change 1-to-1 with the price of the stock. And that's what you need to bear. That's why when I say in the chat room that, it's Thursday afternoon, tomorrow is option expiration, and there is a huge open interest at 100 on the 100 strike line. And if there is something that happens the night before, the Thursday night before, that causes a drastic change in the price of the stock, all those market makers who were hedged delta neutral, now to re-hedge themselves, they basically have to double up on their position, right? Because the thing just takes off on them, and their delta goes from 0.5 to 1 in no time.
Yep.
Because there is nothing left in terms of time or implied volatility. There is only price, and that's what you call, that's what they call bowling for strikes, right? When market makers or people who are short a particular position find themselves having to chase their hedge by buying more and more, and of course, in the case of a call, of course. And of course, the more they have to buy to cover their short position, the more the price goes up. And so the next price now becomes at the money. That gamma can start kicking in, and the process starts snowballing. And I heard a lot of people saying, they call it bowling for strikes. As each strike gets taken out, the gamma kicks in. the delta goes up, the hedges must be replaced, and so on.
Right.
But other than in those instances when you're talking about right before expiration, gamma really is not something that retail investors need to worry too much about. Delta is the important part, and the implied volatility is the important part.
Right. Right. I guess if you were maintaining a long-term hedge, you might see gamma changing the delta as you move farther away. But other than that, those aren't going to be
right.
big deal.
Right.
So, all right, everyone. Thanks for coming, and we'll have more of these shows and more education in the weeks to come. And just wanted to thank everyone for spending the time with us, and thank you, Phil, for sharing your time and wisdom with us as well. It's been wonderful.
And if I can throw in an absolutely shameless plug for both the chat room, Maddie's chat room. It's I don't trade nearly as fast as she does, and as a lot of the guys in the chat room do, but it's pretty remarkable, the eyes that she has for levels and for quick trading. It's truly remarkable. And if you guys are interested in options, I post stuff in the chat room. I post stuff on Twitter, and I am a regular contributor on the Buzz and Banner, Minionville Buzz and Banner. And Minionville also has a premium product geared strictly to options trading. Hopefully, we'll see you guys around in one of those venues.
Fantastic. Thanks, everyone. We'll see you on Monday.
Good weekend.